Welcome to Dual Econ. We are back again. Me, Curse of Crypto. We got Mike. Mike in the building. What's up, Mike? What's up, Mike?
Going on, bro? What's going on?
Not much, man. So today we are going to be doing a reaction video on Jerome Powell's speech at the Jackson Hole video. Stay tuned. Let's get into this. All right, man. So what we're going to do, we're going to just let the video play so you guys can hear exactly what he's saying, and we're going to do our reaction after the video is playing as well. So we're sitting in the audience just like everybody else is watching these,
Taking our notes too.
taking our notes too, and see, we're going to ask each other questions. So I just want y'all to know too, the previous video that we did, if y'all could just look at that background. Like, bro, just look at the background, bro. Like that look.
The last video that we did was on the BRIC summit, and I'm not gonna say my opinion on how the summit looked or anything, but it did look a lot different compared to the background that we're seeing at this Jackson Hole Symposium. Of course, it's not like a G7 event or anything, but
I mean, it just, bro, it looked like Jason in there somewhere, man.
ain't nothing wrong with a little horror movie type vibe, I guess. But shoot, maybe they're trying to match the theme or something. I don't know what's going on, bro.
Maybe, man, maybe. So
I
that's
don't know,
funny.
dog. There's the tablecloth, the lighter, the wall. But let's see what they got to say, though, man.
Let's see what they got to say, man. Let's see what they got to say. All right, here we go.
I want to welcome you to the 2023 Jackson Hole Conference, Structural Shifts in the Global Economy. Chair Powell, the floor is yours.
Can you turn it up just a little bit, dog?
And I know brief. Thank you, Betsy, and good morning, everyone. At last year's Jackson Hole Symposium, I delivered a brief, direct message. My remarks this year will be a bit longer, but the message is the same. It is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. Today, I will review our progress so far and discuss the outlook and the uncertainties we face as we pursue our dual mandate goals. I will conclude with a summary of what this means for policy. Given how far we have come, at upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. The ongoing episode of high inflation initially emerged from a collision between very strong demand and pandemic-constrained supply. By the time the FOMC raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. While these two forces are now working together to bring down inflation, the process still has a long way to go, even with the more favorable recent readings. On a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022 and declined to 3.3% as of July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since early 2022. Headline inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome. But 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We can't yet know the extent to which these lower readings will continue or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the three broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well. And we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, Restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's symposium, the two-year real yield is up about 250 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend, and recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54 and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, So far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical.
What?
At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed
You heard he
carefully
just said.
as we decide whether to tighten further.
You can't put no
or instead
feathers on this, man.
hold the policy
I
rate
want to talk
constant
about it.
and await further data.
I just don't think he's
Restoring
Shakespeare or
price
something.
stability is essential to
Let me go
achieving
back just
both
a little bit.
sides
Can
of
you go
our
back just a little bit?
mandate. We will need price stability to achieve a sustained period. We will need price stability to
Just a little bit more.
hold the policy rate constant and await further data.
Oh, yeah.
Restoring price stability
Now, just a little bit
is
more. I want to hear what he
essential
said
to
about the cloud
achieving
sky.
both sides of our dual mandate.
And following the
Progress
star.
based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully. Too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
All right, bro, let's get into it. I know you thinking the same thing, but I want to start by saying this, bro. And I know you and all the viewers heard this. First of all, he said uncertainty would or could at least about 10 times in this speech. And he also just said around the end of the speech that he is navigating using stars under cloudy skies. It is impossible to navigate using stars if the sky is cloudy. So is it me, bro? Is it me? Or did Jerome Powell just basically say, I have no idea what's about to happen?
Nah, it's like we thinking the same thing. I'm thinking the same thing. I'm like, bro, they don't even know what's going on.
He said, we are navigating using the stars under cloudy skies.
I mean, bro, honestly, bro, you shouldn't even. I guess we shouldn't even be mad at people that don't really understand this because they don't even because the folks that saying it don't even understand it, bro.
Well,
That's easy.
You got some notes, or you want me to go through my notes? I got a lot of stuff. It's not a whole lot.
Honestly, bro. I probably don't have as much stuff as you do. Like, it's the same thing every meeting. But this is what I will say though. This is what I will say. If they don't know what they're doing, man. And this is just me personally. I think they're waiting for something to break outside of fiscal, you know what I'm saying? Fiscal policy, because it's like,
if you go back to every video we talk about, I've been saying for the longest that they're gonna do this until something breaks. They're gonna hold it until something breaks.
But something breaking can be, you know, you coughing, you know, it can be some kind of black swan event, and that
it's gonna be simple. He said exactly what's gonna break. Okay. When I can tell you right now, he is gonna be jobs.
Jobs.
It's gonna be jobs. All this stuff they're gonna.
That's what I'm saying. So what's gonna cause people from losing? Like, something's gonna have to cause people.
Let me get into my notes
for this huge layoff to happen. You know,
let me get into my notes of what he just said. He just said that inflation is still too high. Mm-hmm. He said we still have a long way to go. I'm assuming he's referring to this Federal Reserve in terms of fighting inflation. He mentioned that he was uncertain multiple times as to what was going to happen. He said he does not know how long this will continue. They basically separated the economy into three sections. He talked about separating to goods, housing, and non-housing. He said demands for goods was going down and the supply was going higher. If the demand is going down and the supply is going higher, that means the price of goods is about to fall. For an example of that, he used cars. He talked about how during the pandemic, the supply went down due to chip shortages and people not being able to leave the house, and the demand went up because, of course, same reason.
Everybody was buying cars, buying all kind of cars.
And he mentioned how right now the demand is going down because, you know what I'm saying, people that bought what they was going to buy, number one. He mentioned how the supply is higher because now you don't have those logistics restrictions. So he mentioned that for that reason, he expected inflation to go down. You can keep it on us, brother. You know, he explained that for that reason, goods was going to go down. Next, he mentioned housing. He said demand for housing is falling due to interest rates, which is what he calls. Also, he said that when we talked about goods and the cars a few seconds ago, he said that they were also going down because the interest rate on cars is so high for the goods sector, which also he calls. So he said based off of their plan is being reduced accordingly. But he also said that there's been a recent slight surge in home buying. So maybe they're going to end up increasing interest rates just a little bit more to prevent more home buying. So I can see that being a possible thing. Hold on. Let's see what else he said.
So they're just gonna go and just stop that growth from happening right there. Okay.
That's what interest rates are doing. Mortgage rates have almost doubled over the past 2 years, bro.
But you see how they said it was like, I guess it was like a little spike coming up. We were like, oh no, we can't let that do. We can't let that spike.
You can't. No, that's what he's basically saying. He said rents are going to start increasing at a lesser rate or either decreasing. He said that also. So let's see what else.
Which is crazy though, bro, because like they're the ones that's actually making this happen.
That's his point, bro. He's saying that interest rates were too high, so now we're seeing this stuff come down as a result of of us raising rates. So he's saying that that's working, but he's saying the problem is even though that's working, we're seeing a slight surge in home buying. So that means that when it comes to homes, even though it's been working, people still willing to buy. So we might be pushed to raise rates a little bit more. We don't know yet. But if people continue to buy homes and stuff, we're going to start raising rates even more. That's basically what he just said. He also said that GDP is above expectation, which is the growth of the economy. He said consumer spending is above expectation. He also said, like I just mentioned, that housing is slightly above the expectation right now. So for all that reason, he may have to do more tightening. He said himself that for those reasons, he may have to do more tightening, which would be to keep interest rates higher or keep them high for longer.
Yeah. I think we're going to get one more. We'll probably get one more this year.
After that, he said jobs are trending lower. He had no problem with that, as if that was a great thing, because that was the plan for wages and jobs to trend lower. He said that they need to continue easing wage pressure, meaning that high wages are affecting high prices, causing inflation. So he want wages to go down. He want, last time I checked, I think it was like 2 jobs per person. They wanted that ratio to go down. He said that real wage growth has been increasing, and he wants that to go down. So in order to combat that, you're going to have to take away more jobs or increase interest rates or keep them high longer, so companies can lose more money. Therefore, begin either not increasing wages over time or either getting rid of people, bro.
Yeah.
And earlier you mentioned in one of the videos we did in the past, and I'm trying to keep going through this. In one of our past videos, you mentioned how at your job that I think you said that they were not hiring it. What was it or something like that?
No. So they were laying people off, man. They were laying people off. Not only were they laying the people off, but there weren't that many trucks coming in to get
That's
this
what it
stuff.
was.
And then, you know what I mean? And then we ran into a problem because it was like overproduction, not a lot of workers, not really a lot of trucks. You know what I'm saying? So now it's like we got all this supply with nobody ain't getting it. You know
And
what I mean? Ain't buying it.
that's what they want to happen, bro. That's how you do. If you got a bunch of supply and nobody is buying it, that means that demand is going down. Therefore, prices have to go down, which will cause inflation to go down.
Yeah.
My point I'm bringing that up because in the last video where we talked about jobs and stuff, I forgot to mention that at my job, because I was so thinking so much about what you was talking about. At my job, it's been a hiring freeze for over a year.
Sheesh.
Yeah. It's been a hiring freeze for over a year.
Yeah. Yeah. So what? Yeah. So.
But let me. I'm getting off task. So let me get back on focus. Jerome Powell said this would be some of the resolutions. He said restrictive money policy. So that means more restrictions. That means potentially more interest rate, less government spending. Hopefully, he said this will require a period of below trend market growth. Trend market growth is 2% market growth. He said it's going to be required that we have below trend market growth. Right now, the market, I think, is at like 4.5% as far as the inflation rate. In order for us to have below trend growth, that means that growth will have to go down negative from where it is now.
Mm.
So if you're trying to decrease market growth, that could also technically lead to recession. He said GDP was above expectation. If you end up driving GDP negative, you end up with a recession. So technically, he know he got to take GDP down. He know he got to take jobs down. He know that he has to take market growth down. But if he does it too much, it's 100% definitely going to lead to another recession. And we just came out of one last year. And we just came out of, well, technically last year. And we just came out of one in 2020 also. So if he was to push too hard or signal that he's going to push too hard, he would basically end up causing a recession. But I feel like that's why he keeps saying if, or we're going to be watching the data. And I think that's why they ended up slowing down on increasing the rates. But
so this will be one of those double bottom recessions we will be in. This
right now is between a rock and a hard place because they've already raised interest rates basically to what they were during the Great Recession, bro. And if like you said earlier, if they raise any more, which they're gonna have to do, but if they raise too much, they risk overcorrecting and not only just getting back to they risk, of course, you would still be able to get to a 2% interest rate, but they risk the chance of negative GDP while doing that, which would be a recession.
Yeah.
And if they was to pop that off too early, let's say that it takes them a year to take interest rates down once they decide to come up with that plan or once something happens. If GDP was to go negative before that happened, and then you end up tearing down more jobs after that was to happen, knowing that we definitely gonna have to do it slowly. But if the GDP was to go negative and then it's kept happening, then you would have a long, drawn out recession. So I think the Federal Reserve and Jerome Powell really are trying to skate that narrow line of correcting without correcting too much.
To where we in that long bear market. Oh, golly, bro.
Did you get what I'm saying? He GDP definitely has to go down. We want it to go down. But if we get two quarters of negative GDP, that's a recession.
Yeah, I mean, honestly, bro, I ain't gonna lie to you. Like, even though I think the bull market has started, I still think we're in a recession right now. Like,
Yeah, me too. Me too.
I don't think we've gotten
Me
out of it
too.
yet.
Me too.
You know what I'm saying?
He was saying that consumer spending is above trend. If you take consumer spending down, yeah, we need them to start spending less. But if you straight up restrict the money and consumers don't have the money,
Yeah,
you see what I'm saying? Like,
yeah, man.
it's tough. Wage growth, okay, we're gonna cut back on wages, but what happened to the people who can't pay their rent because of the inflationary prices,
Yeah,
which are gonna lag as far as them decreasing, bro? Like, that's definitely.
and the whole time all this happening, like we said, they don't even know.
So shit. What Jerome like? Well, hey, what can I do? You know what I'm saying? You know what I'm saying? He's like, I gotta watch. I gotta wait. You know,
Yeah, but that's why they in that haunted. That's why they in that haunted ass background, bro. You know what I mean?
They brought me out here. Brought me out here for this bull. I done told y'all this last month. You know what I'm saying? Like, y'all done brought me out here to the
Oh, that must. Oh man, I know that just must suck to be able to just have to go up there and say that, and then it's like you, like man, I gotta keep on saying this, man. Keep on, like y'all already know.
Yeah.
You know what I mean? That's why they got that haunted background, bro. Because it ain't nothing.
But
What positive is there? What really positive is there to say, man? Like, because you don't want people to lose their jobs. Heck no, man. But
technically, you gotta reduce wages.
you
know what I'm saying?
in order to get out of this entire situation, that has to happen. You know what I'm saying? So
Did you have any specific notes that was like different from that though?
I mean, honestly, bro, not really, man. Not really, man. Like I'm just like Jerome. I'm waiting for something to break.
All right, no, well,
Like, for real.
to say this, I do want to leave a question with the viewers before we go, because we are about to work on the weekly rundown video. This video right here is going to air on Saturday. The weekly rundown video that we're going to do is going to air tomorrow. So make sure y'all subscribe and stick around for that video. But I do want to leave the subscribers with a question. My question for this video, and leave your answer in the comments. Based off of all the stuff that we see that's going on in the world, the economic events, and everything that you have to be prepared for, what is the best way right now, or if we were to go into a crisis, or whatever you think is going to happen right now, what is the best way that you guys personally think that you should, the best means to protect and save your wealth right now? And I mean that, and over, like, let's say all this stuff is going on between now and 2025. What do you guys think is the best method of saving and protecting wealth between now and 2025? We're not going to give our answer in this video. In our next video, probably the weekly rundown, well, probably next video that we do during the week, we'll pull this question back, kind of go through some of our answers with the viewers, and we're probably going to start doing that maybe once or twice a week in our videos. So definitely leave your answers in the comments. We're about to go ahead and get ready for this next video that we got out.
Hey, the first person to put their comment down, I'll send them 25 XRP tokens.
All right, so Marcus said the first person that comments their answer, he's going to send them 25 XRP tokens. So
first person to make a comment and answer that question, I'm gonna send them 25 XRP tokens.
And I guess it's like a prize to you guys for answering the question and sticking to the end of the video. So once again, the question is, what do you guys think is going to be the best method to save and protect your wealth from now into 2025? With that being said, we will see you guys in the next video. Make sure y'all subscribe to the channel. Check the description below for different links that may be helpful to you all. With that being said, we'll see y'all on the next one. We out.